Welcome to the Investsense market commentary for the last week of March 2025 and for the first quarter as a whole. And as you can see from the chart, markets ended the quarter on the back foot as they have been throughout most of March. And again, it was the Magnificent Seven, that dotted purple line at the bottom, which bore the brunt of it, down kind of almost 10% during the week before bouncing a little bit overnight. And as we've come to expect recently, other markets like Australia, like the UK, like even emerging markets proving to be a bit less volatile and just down a few percent. Meanwhile, gold up another 4% in just a few days. Now, at the end of last week, the proximate reason was some weaker data on the manufacturing and also on the services side in the US, pointing to a sort of slowing US economy. But most of all, it was probably the PCE inflation deflator, so that's the Federal Reserve's preferred measure of inflation, just ticked up a little bit and was a little bit higher than expectations, pointing to inflation that may be looking like 3% or above going forward. Now, the last inflation print was the CPI print, which has actually zagged downwards. Meanwhile, this zagged upwards month on month. Almost 0.4%, but on top of a positive print in the month before. And if you chain that together over the last 6 months, there seems to be a little bit of an upwards trend. Now, the market is starting to sniff out potentially higher inflation. Maybe this is tariff related, but what you've got in front of there, the white line there, is market implied via the swaps markets inflation, which is saying that a year from now inflation could be at about 3% and rising. And the dotted line down there, the white one, showing 5-year rates or rates in 5 years, perhaps just ticking up a little bit in the mid sort of 2.5, 2.6. So fairly moderate at that level, but near term, the market seems to be sniffing something out. And the last time we saw that was really just in 2021. And that's what's maybe making people a little bit wary. Not quite at that level yet, but something to watch out for. On the other hand, if there is a recession around the corner, it could be a deflationary impulse, and we're getting back into that whole debate about deflation versus inflation and a little bit of a pivot point, which is going to keep people talking for a while. But if we zoom out just a little bit, especially for Australian investors as a quarter as a whole, gold is up 20%. Now, that might be risk aversion or the so-called repatriation trade, where people are taking money out of the US, potentially more wary of US treasuries, etc. But that repatriation trade has also helped markets like Europe. So in Aussie dollar terms, up 10% still for the quarter or the year to date, helped a little bit by the weakening of the Aussie dollar at the same time. But in local currency terms, also up 6 or 7%. The UK also up a similar amount. Emerging markets up 5%. Small caps ex-US, similar amount. Even Japan up. The Australian market, due to a slightly sort of weak reporting season and maybe some concerns around global growth, down a few percent. And then underneath that, all the US indices, S&P 500 down 5%, NASDAQ a little bit more, and of course the so-called Magnificent Seven down by more than 15%, certainly in Aussie dollar terms, over the last quarter. Now, what does that mean for a diversified investor? Well, as you can see, if you were leaning into those assets, those cheaper assets that have done relatively well, you would have been a little bit cushioned, and also the Aussie dollar, and also the weaker Aussie dollar helping out a little bit. So when you put that all together, actually a 70-30 equity defensive split investor, actually almost. So when you put that together, a so-called 70-30 fund with 70% invested in equities and the rest in defensive assets has actually been flat for the year. If that's a sort of active fund, which has probably got less US equities, and even a passive fund only down 1%. So nothing too dramatic, especially if you have a diversified portfolio. Now, in this week's video, JT and I discussed the recent visit we had from Andrew Hunt of Hunt Economics, and one of the main themes that he was talking about was First of all, the so-called Doge initiative led by Elon Musk has had some extent in slowing fiscal spending. Whether it's going to have long-term impact on some of the things that are more difficult to cut, like defense spending and Medicare, etc., is still open up for debate. But it seems to have turned the tap off to some extent, and that seems to be flowing into the US economy. But also the other thing that he was talking about was this concept of policy uncertainty and the extent to which it's slowing down decision making and corporate CEOs putting off spending, etc. It seems to be having a tangible impact on investment decisions, as well as that repatriation trade that we talked about before. But he did talk about signs of life, for instance, in the so-called pigs, the southern economies in Europe, where you're seeing a higher economic activity. But the overall sense was that this cycle might be different, and this repatriation trade is somewhat significant because normally in times of uncertainty, money floods back into the US. Well, for one reason or another, probably related to tariffs and some of the Trump policies, it seems to be going the other way. People are repatriating money away from the US. So it'll be interesting to see how much that continues. So in terms of timelines, Andrew was talking about a 3 to 6 month time horizon where we'll get more clarity on whether we're going to see more of an entrenched recession in the US, or whether another intriguing prospect, a creative funding mechanism related to crypto markets and the use of stable coins as collateral, which might actually facilitate more lending and could serve a role in underpinning the US Treasury market and maintaining lower yields, which is something that we've seen despite higher inflation so far this year. One of the surprising things about markets has been the extent to which US yields have actually continued to fall during the year. Maybe that's one of the contributory factors. And we also talk about some of the portfolio implications which I've laid out there, although of course that is not advice aimed at any individual in particular. So obviously the talk of the town over the next week is going to be so-called Liberation Day on April the 2nd. So that'll be Thursday when we wake up, and we'll have heard more from Trump as he gives his speech from the Rose Garden. And he's intimated that it's not just going to be the 15 countries that have the biggest surpluses vis-a-vis the US, but it's going to be all countries, quite encompassing. Seems to be doubling down on this, and the kind of things he'll be looking to achieve or to please his constituency will be to be seen to be protecting the US from unfair competition, also trying to generate revenue from this, although economists debate about how possible this is, or is it just about economic leverage and a little bit of game theory? And can it longer term point to a manufacturing revival in the US? Now, the things that the market will be looking for is how much is this going to affect inflation? Is it going to cost the consumer? Are we going to see supply chain disruptions? We're already starting to see that in things like auto parts between Mexico and Canada and the US. Will this tip the economy into a recession? And is it going to have long-lasting effects on the global trade pattern? Are we going to see a sort of US versus rest of the world, or are we going to see a resumption if Trump gets what he wants in the first instance? Or are we going to see an escalation and more market volatility? But amidst all of this, it's maybe worth remembering that uncertainty is a two-way street, and we've got here the Global Economic Policy Uncertainty Index, and you can see this is sort of based to 100, and we've seen in the last few years with Brexit, with COVID, and latterly with the Trump administration and the threat of tariffs, this has gone to all-time highs. But in past instances, you can see when that uncertainty starts to dissipate, it tends to support markets. And the blue line you can see here is MSCI World, and particularly around COVID, where we saw that index skyrocket. It's actually around March the 31st when we saw the turn in markets, when people got a sense that governments had a handle on this thing. That was when markets took off, and they didn't look back for another couple of years. But as you can see, as inflation reared its head during 21, that uncertainty index increased again, and here we've had this latest surge. So from here, it's actually surprising when you look at that chart that markets haven't been on the back foot by more, and maybe in the next few days we'll learn whether it's a sigh of relief belief that things are not quite as bad as they thought they were, or whether it's something else and markets decide that this latest uptick in uncertainty is something which needs to be discounted more. So it's going to be an exciting few days, we suspect, and hopefully when we talk again in a week, then we're looking at a calmer environment, but look forward to discussing more then.